Hi, everyone. I'm Gary Brode from Deep Knowledge Investing. We work with hedge funds, family offices, registered investment advisors, and individuals like you to help you get better returns in the stock market. I'm here with our host, Robb Fahrion from Flying V Group. He's the founder and CEO of our digital marketing partner. Robb, how was your week?
Week was great last week. This week is off to a thrilling start, I would say. I probably should have told you this as meeting prep, but it might have so I'd be curious on your commentary. Earlier today, mailman comes in with a certified envelope, and obviously you can see through the little from the IRS. So
Mm-hmm.
that was a fun start to my Monday. Open that up right away, just say, hey, let's get it over with, see what happens. Got a nice notice to levy property because we owe them $165.
Okay, so your property has been what they have a lien on your property?
No, that's a
Oh.
threat of the potential unless we make sure we satisfy our $165. But I thought it was funny talking about the IRS agents that are hired, made a little joke of it on social media that they are coming for everybody.
I got to tell you something. One of my great frustrations when we do this, a lot of times, Rob, when we talk about government policy, tax policy, inevitably when I say, hey, listen, this is not going to end well, people say, what does it matter? They're rich people. We should tax the rich more, get the billionaires. Okay, well, two issues. First of all, we could tax every billionaire in the country at 100%. We could grab all their assets. That's going to pay our government expenses for, less than a day. So that the asset confiscation from the ultra wealthy isn't going to solve anything. But beyond that, we have something like a few thousand families in the US that have a net worth of over $100 million. Good for them. Congratulations. And every time I hear people saying, "Oh, well, we just need to tax those rich people, those evil rich people more. Go get them." I think what people are forgetting is we didn't hire 87,000 new IRS agents to track down the few hundred or few thousand families that have a nine-figure net worth, right? And so if you're listening to this, they hired those 87,000 IRS agents to come after you. That's what they're there for. They're not there to go after the ultra wealthy. If you're listening to this, they want your money.
There was
So
actually a handwritten note at the bottom of it that said, "We heard what you guys have been saying on the
yeah.
DKI Five Things podcast."
So we've gone from micro famous to now we're on a government list.
Yes, we are targets for sure.
Exactly. Well, so for the literary people in the crowd, we'll see you in room 101.
Gary, we got a fun issue this week. It's finally here. We're calling this the Pivot Week issue, but we got a lot of other great topics that we're going to get through. We're talking about uranium again. GameStop, everybody's favorite, makes another appearance. CPI, we're talking Las Vegas Sands, been in the five things here pretty recently. DKI portfolio company. And then at the end, we're talking a little bit about the value of compounding and long-term investing. Gary, any notes before we kind of jump into the five things?
Just everyone get ready. This is pivot week, right? People have been waiting 2 years for the Fed pivot. It is coming in 2 days. So, if you're excited for that, if you think this is a good idea, in less than 2 days, you will have your pivot. DKI has spent the last almost 2 years, really more than a year and a half, more than 2 years, pardon me. We
Mhm.
started saying this in mid-June of 2022 when people
Yep.
started talking about pivoting. Then we said, absolutely not. It's not going to happen. And I have spent more than the last 2 years telling people the Fed is not about to pivot. And we've been right for that time. And then, I think about a month and a half ago, we realized, okay, it's coming, and that is happening on Wednesday. So, um, we were correct in saying it's going to be a couple of years. It's going to be a long time, but it is now coming on Wednesday. We are going to get the pivot, and here we are.
All
So,
right.
get excited for more inflation. It's on the way.
Gary, thing number one, we're talking Russia has been talking about limiting exports on uranium. The market is already in a deficit. Gary, thing number one of this week's five things, the pivot week issue. Is uranium the next big play in energy? Tell us more about that.
So, Rob, this is a confluence of two events. First, in the first quarter of 2022, when Russia invaded Ukraine, the United States put in place a series of financial sanctions against Russia. At the time, DKI came out. I wrote a whole bunch of lengthy pieces explaining why these sanctions were not going to be effective. People got angry. They thought I was supporting Putin. I was not. I'm not. My point was the sanctions were not going to be effective. They haven't been. I'm not cheering for Putin. I'm not on their side. I'm saying we didn't design the sanctions well. Um, anyway, so 2.5 years later, the Russian economy is not in shambles. The Russian ability to make war has not been eliminated. And now with uranium supplies tight on a worldwide basis, it's something we've been talking about on this channel, on this show for months. Putin is now saying that Russia is considering imposing export restrictions on uranium. That would cause an already tight worldwide market to tighten even more. Russia is one of the large producers in the world. There are a few countries that produce a lot of uranium, but it's not a long list. And that market is extremely tight right now. The current demand for uranium is somewhere in the neighborhood of 15 to 30 million tons above current supply. And, one of the things we've talked about is that a lot of the big suppliers, and we've talked about Kazatomprom, we've talked about CCJ out of Canada, that's Cameco, they're not increasing supply. They're actually buying in the spot market. So this is, potentially an issue for people who want uranium. It is potentially a benefit for people who own uranium, like DKI subscribers. The other thing, I give our subscribers a ton of credit. I had multiple people in the last week pinging my inbox talking about the U.S. repurposing warheads. So what they're doing is they're taking apart nuclear warheads and using that fuel to power nuclear reactors. Sounds like a pretty good idea, right? Better to make energy than war. I totally get that. But the sort of fear was, oh no, if we do this, is the price of uranium going to drop? And if you take a look, the estimate is that the US needs something like 40 million tons of uranium between now and 2030. So ballpark half a decade. Our current capacity to prepare, it's called HALEU. I have no idea if I'm pronouncing that right. It's spelled HALEU. It stands for high assay, low enriched uranium. But our ability to turn that into fuel in a nuclear reactor is less than 1 million tons per year. So we need 40 over the next 5 years. We can produce under 1 per year, or a total of, somewhere 4 to 6 over the next few years. So, I understand. I think it's great that people were sending me this information and saying, hey, does this matter? Love getting that kind of feedback, love having those discussions with our subscribers. But the answer is, this may be it may be good policy, but it's not going to be enough to create enough supply to satisfy the excess demand.
Gary, the U.S. has leaned heavily on Russia's uranium reserves. Obviously, the war in Ukraine risks that. With this limiting supply coming from Russia, the U.S. is rushing to develop, as you're mentioning. Two-part question here. Number one, why are we rushing? Why were we not proactive? And secondly, why uranium as well?
Well, so let's take those in reverse order.
Sure.
The reason uranium matters is it's for two reasons. One is there is an almost perfect correlation between energy use and having a high material quality of living. If you take a look, however you want to define being materially comfortable, having lots of goods and services, living a comfortable life. Again, we're not talking about your spiritual life or your family life. These things matter. But we're talking about a material life. There's an almost perfect correlation. As you use more energy, you have a more comfortable life. there are, roughly 3 billion people in the world, and just China and India alone, that want better lives, that want to be more comfortable. At a minimum, the people in India certainly want air conditioning. Um, and so, or at least a large part of India. Um, so nuclear power is reliable, it is incredibly efficient, and it's carbon free. So for environmental reasons, right or wrong, it's very hard to get projects approved that will put a lot of carbon into the atmosphere. And I'm not taking a political stand on this. I know there are people who feel very strongly on both sides, but if you think that the amount of carbon we put in the atmosphere doesn't matter, you'd still like nuclear because it's reliable and inexpensive. If, on the other hand, you believe that putting carbon into the atmosphere is going to destroy the planet, you should love nuclear because it is carbon-free energy. The other thing is, take a look, this, all the EVs that people want, the AI future that people want, those data centers use something like 6 or 7 times as much energy as a regular data center, an AI-based one. Those NVIDIA chips use massive amounts of energy. And so basically, everything that everybody wants to live what they would consider to be a good life will require more energy. Politically, it's not feasible to build a lot of carbon use kinds of plants. Things like solar and wind are not reliable enough to power a data center where you need like 99.999% uptime and reliability. So uranium is the answer to that. Nuclear is the answer to that. And the reason this matters is because the world has been in deficit for years. And right now, the annual deficit, like I said, is 15 to 30 million tons a year. Ballpark 2-3 years ago, worldwide not supply, worldwide stockpiles were about 150 million pounds. And so we're down to maybe like 2-3 years of of enough supply. And what's happening right now is people are building nuclear plants all over the world. People are extending the permitted life of plants from 40 years to 60 years. And, we just saw a couple weeks ago in Michigan, they are trying to recommission a decommissioned nuclear plant. This has never been done in the history of the world. So demand is not changing. Why we're late on this? I don't know, Rob. In general, the United States does not have a functional energy policy. I wrote an article about that a couple of years ago, that our current administration does not have anything resembling a coherent energy policy. None of this makes sense. And so, people should be reacting to it. But until they do, what that means is that demand for uranium is continuing to go up. Supply is not reacting. We're already in a deficit. And I can tell you personally, I own enormous amounts of uranium because the only thing that can adjust right here is the price. DKI subscribers have been in uranium for a couple of years now. Our returns in the name and their returns, our subscribers' returns, have been enormous. We've made a ton of money on this thesis.
Gary, great summary there on uranium, the market, what's happening. And obviously, premium subscribers have access to that portfolio position, as well as any of Gary's moves within the portfolio as time goes on. Thing number 2, we're transitioning to our favorite GameStop, ticker GME. GameStop actually returned to profitability, but we need to take a look at the fall in revenue. Gary, you're saying it's a problem. Thing number 2, Gary, GME earnings plus ATM offering. Thing number 2.
So, Rob, I'm going to apologize to you first because we're gonna get hate mail on this one. Sorry to
Bring
the
it on.
apes. Yeah,
I'm a marketing guy. Any publicity is good publicity. So
yeah.
we'll take anything from anyone.
Yeah, exactly. So to the GameStop apes, I'm not against you guys. I just don't think from a fundamental point of view you're on the right side of this one. And I get it, it's send the hate mail to Robb Fahrion. He's an advertising guy. He loves the publicity.
I got to deal with the
Um,
IRS and GameStop apes at this point. I don't know, Gary. I might be out of here.
it's a lot of stress. I know. Anyway, last week GameStop announced earnings, and people, I was looking at the commentary on Twitter or X. People were very excited. Analysts were expecting a 9-cent loss. They got a 1-cent profit. With the stock in the 20s, that's still kind of an enormous multiple. And they were also very excited about the fact that the company has an enormous amount of cash on the balance sheet. Okay, well, unfortunately, here's the downside. You remember last week when we were talking about the importance of revenue growth and the warning of companies that continually miss revenue and have declining revenue, on how that's bad for long-term valuations. This, by the way, if people want to check it out, it was thing 5 from last week. Well, GameStop revenue in 2017 was $8.5 billion. That has fallen down to $5.3 billion last year. And the quarter that was just announced, revenue was 798 million. That missed estimates by 11% and was down 31% from the year before. So we just saw this company lose, something like 40% of their revenue over under a decade. And in the last quarter, revenue was down 31%. I get that people are angry that the shorts are manipulating the short interest. There's no question. There are some shenanigans going on, and that, people have gotten away with. I get why people are mad that the short interest is being violated and manipulated. I completely understand the anger that the GameStop apes have when the buy button was turned off. These are things that shouldn't happen. We should have a free and fair market. You guys aren't getting that. That said, even in a clean, non-manipulated market, it's dangerous to be in stocks where your revenue is in a long-term slide and you just reported a quarter down 31%. This is not the sign of a healthy business.
Gary, there was also some intrigue around a $20 million share secondary offering. It was in a May 2024 prospectus. You note that the last time this was said, share offering followed quickly. You are cautioning, though, investors may want to watch their back. And I want to read what management said. There are no current plans, commitments, or arrangements to make any new acquisitions or investments. That's coming directly from management. Gary, what does this mean for GameStop investors?
Well, Rob, the thing that you're referring to is actually the reason why GameStop has so much cash on the balance sheet. Basically this, from a fundamental point of view, this business is failing. Sorry, apes. I know it's the last thing you want to hear, but it is. Seeing $8.5 billion of revenue approaching $5 billion, seeing revenue down 31% in one quarter. And the fact is, everything they sell, you can buy on Amazon, or alternatively, you can just get digital distribution, right? So I've been a gamer since I was a kid. My PlayStation, I can just go on the PlayStation store. You click a button, the game just shows up. You don't need to go to a GameStop. At any rate, so what happened was, Roaring Kitty, who from a fundamental point of view has been wrong about this name, but from a marketing point of view has been a genius. I have never in my life seen anybody use social media so adeptly, and his genius in getting a large number of people interested in the stock and involved in the stock and investing. I've never seen anything like it before. And on that part, he's been incredible. And what that did was that caused the stock to go up an enormous amount, and management, realizing they didn't have a fundamental business that was performing well, took advantage of the Roaring Kitty excitement that that caused the stock price to rise. And they sold tons and tons of stock. And then, the GameStop shareholders got excited, like, oh my God, we have billions of dollars of cash. They could buy a business. They're not doing that. They could buy gold. They're not doing that. They could buy Bitcoin. Not doing that. They don't have plans. This literally was, we've got a business that's failing. We have the stock up on a temporary basis, due not to fundamentals, but rather due to social media marketing. And they sold stock and they booked the cash. And so, management is flat out telling you, we're not doing any of those things. We don't have plans for any of that. But the fundamental underlying business is failing. Now, the one thing I've seen people say is, but wait a minute, they could be like Michael Saylor and buy tons of Bitcoin. And wouldn't that be fantastic? And my response to all of you is, yeah, first of all, Saylor is kind of a one of one situation. Don't count on that here. But I love Bitcoin. I think we're going to get to this in thing three. I think we're going to be looking at continued inflation. I think we're going to look at the long-term decline in purchasing power of the dollar. To that end, I like owning gold. I love owning Bitcoin, but you don't need to buy GameStop stock with a declining underlying fundamental business with your fingers crossed that management will then go out and buy Bitcoin and you'll own it through GameStop. You can take the money that you have invested in GameStop and instead buy Bitcoin. And if you're going to do that, and I think doing that is a great idea, but if you're going to do that, my one caution is that expression that we've all heard so many times, not your keys, not your coins. There's a reason that expression is stuck around. It's important. It matters. So if you're going to do this, we strongly recommend self-custody. If that's difficult, if you don't know how, if you're worried, and I understand it can be scary. It can be scary to transfer Bitcoin and there's no 1-800-Bitcoin help desk to call, right? You can't call the manager. You can't call customer service. It can be a little, it can make people a little bit nervous. But if you want to do it and you don't know how, reach out at ir@deepknowledgeinvesting.com, or just check my Twitter account. It's Gary_Brode on Twitter or X. And we've published a guide to self-custody that is as easy to follow as it could be. So, that's if that's what you're hoping for, you don't have to hope. You can just go out and buy Bitcoin today and do that and solve that. But the key thing here is that you've got a business with declining fundamentals. And, Rob, I'm going to add one more thing. I went back and I watched Roaring Kitty's video from about 4 years ago. And there were two things that jumped out at me, right? So now, we all know him as this social media guy who, has hyped the stock. But the truth is, he did a really good, interesting analysis of the company's business. I think he's somebody who legitimately understands businesses. I think he understands investing. And I thought his presentation was excellent. And he had all of these ideas for what GameStop would and could do to increase revenue. And they were really good ideas. The downside, the problem with it is he happened to be wrong. And I'm not making fun of him for that. We have everybody in this business, myself included, we have all been wrong about a stock pick at one point or another. We've all had an investment thesis that didn't work out. This one didn't work out. His thesis was the company's going to do X, Y, and Z and get more revenue. That didn't happen, right? What they have is a declining business. So, his fundamental analysis I thought was smart and interesting, and without throwing shade, because we've all been wrong, myself included, he just wasn't right on the fundamentals. And when that happens, that's when I exit. If I'm wrong on the fundamentals, you just take the loss, apologize to the people involved, and go find the next one.
Yeah, I don't know about you, Gary, but I think there are plenty of Bitcoin customer support agents on X that are constantly trying to help you out when needed. But disclaimer, be sure to stay away from those guys. And secondly, please don't email me. Let's just have a drag out debate in YouTube comments. I think that would be the best place for it. And we'll see all the apes there.
All right. Yeah. So no one email us, but you can, if you're angry about what we're saying, put it in the comments. Anything where you explain your point. If you just tell us we're idiots, I'm going to ignore that. If you explain your point of view, make your argument, we're happy to engage with the people who both agree and disagree. Just use the word because, I think you're wrong because, and make your point. And, we'll be happy to talk to you about it and, see what we find out.
I think we'll need some AI generated Gary versus the GameStop apes in a
Oh
knockdown
God.
drag out fight.
But here's the thing, Rob. I'm actually like, I'm not against these guys.
I know. I
They have
know.
a legitimate
Yep.
right. First of all, Roaring Kitty's fundamental analysis, it was worth reading or
Sure.
watching. It turned out to be wrong, but it was still interesting analysis. Beyond that, I think the apes have a legitimate point on how secure and fair and even-handed our capital markets are. A lot of their complaints are valid. And I don't think any of those things make GameStop a good argument. I don't think it makes GameStop, their mall-based retail business. I don't think it's going to make that business successful. But they still have a valid point and they should be heard, and people should be listening to them. And by the way, apes, like I'm not kidding. Like we're happy to listen. Like, tell me why you think I'm wrong. Just say because and explain yourself, because as a community, Rob, they do have
Sure.
some really good points,
Sure.
and I think they're worth listening to.
Agree. Agreed, Gary. Getting to thing number three, what everybody's been waiting for, some longer than others. The CPI is down. The Fed is cutting. I should know this. Arthur Burns is expecting company. Is he still alive?
I believe he's not.
Okay.
He was the Fed chairman before Paul Volcker. So he
Right.
was the Fed chairman back in the 1960s and I
Okay.
believe
Yeah.
the early 70s. This is 50 years
Yeah.
later.
Okay.
Yeah. So
Enough said.
I believe he's not still around.
Okay. Gary, thing number three, CPI softens, rate cuts, quote, sooner rather than later, a DKI term, means this week. Gary, let's dive into it with these rates here coming up in the next couple of days.
All right, we are filming this on Monday afternoon, the 16th.
Yep.
On Wednesday, just 2 days from now, the Federal Reserve is going to put out a press release indicating that they have cut the Fed funds rate. After that, Chairman Powell will do a press conference where I predict that he will, field 74 questions, all asking him, how much more they're going to cut and when it's going to happen and what the timing of all of this is. And then he's going to look annoyed and tell everybody we're data driven. We're going to keep cutting, but, we'll do it based on the data and we'll be looking at all of this other stuff. And, however much he cuts, people are going to ask why he didn't do more or less. At any rate, the last piece of data we got was the CPI, the Consumer Price Index. That index is horrendously inaccurate and intentionally so. It is not designed to measure real inflation. But it is, when people talk about inflation, that's the index that people typically talk about. So the August CPI showed an increase of 2.5% for the year and 0.3% for the month. That was below last month's 2.9% and consistent with expectations. When you take a look at this chart, that number that we're talking about is the blue line on the first chart. And you can see it has come down. There's no question that inflation has come down. The core number, which excludes food and energy, that has been consistently sticky. That was 3.2% for the last year, which was also consistent with expectations. The Fed is aiming for 2%, but they're clearly going to reduce rates before we get to 2%. And, for the people who say, well, wait a minute, why do you say the CPI is understated and intentionally so? Here's my question for you. If you're listening to this, and, the Bureau of Labor Statistics tells you that the CPI or inflation is up 2.5%, I'm just going to ask you, are your expenses this year up only 2.5% versus last year? My guess is, for most of the people listening to this or watching this, your personal inflation rate is probably substantially higher. Now, there are some people, who maybe they've locked in their housing costs. They didn't need to buy a car. There are people who will be lower, but I think for most of us, we're experiencing inflation in excess of 2.5%.
Yeah, Gary, the all item CPA is down substantially. Fed Reserve has done all it can to try and bring inflation under control. You think that there's two areas of both current and future issues. Talk to us about those. The first being that current inflation isn't due to Federal Reserve policies.
So that, Rob, that is a huge problem. Typically it's the Fed that is held responsible for inflation and then held responsible for reducing inflation. And, when you take a look at that first chart and you see that inflation has come down, or at least the CPI has come down, people say, okay, great, good job to the Federal Reserve for doing that. The issue is that current inflation is not being caused by a too low federal funds rate. The reason why, even though the Fed now has positive real interest rates would be the Fed funds rate less the CPI. It's saying after inflation, can you earn money in bonds? And the answer right now is yes. But right now, inflation is being caused by massive overspending in Congress. Congress is overspending by about $1 trillion every 100 days. So it'll be, $2-3 trillion this year. Interest expense annualized has gone over $1 trillion. We're now spending more on that than anything else. And what's happening is we're not paying for that out of taxes. We're paying for that through more issuance of currency, more issuance of debt. It's effectively creating more dollars and more liquidity in the economy. And the result of that is inflation. That's how we're paying for all of that spending. And one of the things we've been saying for years, people got excited to get their stimulus checks. And, who's paying for the stimmies? You are. You are paying for your stimmies. And so, when we're running government programs that have a big social safety network, things like welfare and Medicare and Medicaid, and a big military, big defense budget, lots of interest expense, roads projects, infrastructure projects, everything the government spends money on. There are lots of people, who think we should be funding the millions of people who have come across the border and are in the country now. And, they're getting free to them, hotels and food and, all kinds of additional benefits. Listen, if you're for it, fine. If you're against it, fine. We're not taking a stand on that. I'm just pointing out that spending isn't free. And because we're not paying for it in taxes, we're paying for that spending in higher prices. So whatever those government programs are, you're paying for your stimmies. And Powell and the Fed, they don't have control over that. There are two other problems I'd point out, Rob. One is even if the CPI went to zero, let's just say we got rid of inflation. Right now, after years of inflation, price levels are so high that a lot of families are having difficulty making ends meet. And so even if we got inflation down to zero, if you're having difficulty making ends meet, guess what? This doesn't fix that. The other thing is, take a look at the second chart that Andrew's going to toss up here. He did a great job on that chart. And what we did was we tracked the CPI from March of 1966 through December of 1982. And we overlaid that with the CPI starting in September 2013. And, what we see is that they both had this big spike and then interest rates came down. And when that happened, back in the 1970s, then Fed Chairman Arthur Burns let off the gas too early. In fairness to him, Lyndon Johnson picked him up and slammed him against a wall. It was President Johnson at the time. And so Burns caved and he cut rates too early. And we ended up with the horrendous inflation and stagflation that came in the late 1970s. And when you look at this chart, that red line now is where we are. And that's where the Fed's going to cut. And, I understand why people want rate cuts. But a year from now, people may be regretting the rate cuts that are going to start 2 days from now. And if you look at that chart, you'll see the reason why.
We'll keep you in tune with everything happening with the cuts expected to be Thursday. Gary, I'm sure we'll have notes Wednesday, excuse me. We'll have notes on all of that and what to make of it as that happens. and distributed via our premium subscriber, free subscriber list as well, I'm sure, with at least a general update there. Thing number 4, we're moving on to Las Vegas Sands, ticker LVS. They just recently bought more Sands China, 1928.HK. The market is discounting the recovery despite visitation levels above 2019 levels that we talked about. I believe it was last week or the week prior.
Yeah.
Gary, thing number 4, Las Vegas Sands makes a telling move.
Well, Rob, as someone who I own Las Vegas Sands stock, the reason I own it is they're a fantastic operator. They own half the market in Singapore and are building there, and that asset is performing at all-time record highs, even, well, much better than pre-COVID levels. We've also been betting on a recovery in Macau, and we've now gotten that. August visitation in Macau was higher than the 2019 levels. So, Macau is now seeing more visitors than they were seeing pre-COVID. And so, I'm taking a look at this thinking, wait a minute, the stock is acting like there's a gigantic unsolvable problem, but what we really have here is a very full recovery. And the reason the stock has traded so poorly this year is because of fears related to the Chinese economy. Now, in fairness, the people who are worried about that, that's a legitimate fear to have. The Chinese economy is not doing great right now, and there's a reason people are nervous about it. With that said, Macau was shut down or largely shut down for years. China was locked down for another year or two beyond the US. These lockdowns lasted way too long, and people have pent up bankroll. They haven't been able to gamble. They really love to. And what they want to do is go back to the casinos and enjoy themselves. And that's what they're starting to do. So what we're seeing is evidence of a robust recovery, but the stock is trading like there's some gigantic long-term problem related to the Chinese economy. Now, Sands China stock, which owns about 30% of Las Vegas Sands Macau assets, has fallen from almost 25 in February down to below 15 now. That drop is more than 40%. It has been a huge problem. And, management responded last week by buying $103 million in Sands China. I'm going to point out to you that management has inside information. These guys see the daily returns. They know how many people are gambling in their casinos. They know how many bets are being made. They know whether the average bet size is increasing or decreasing. They know the room rates and all their hotels, the occupancy. I mean, forget the intra-quarter information. These guys get daily information on it. So with that inside information, they went and just threw 9 figures at buying more of those assets that are performing well on a fundamental basis, but performing poorly in the stock market.
Yeah, and Gary, earlier this year, LVS bought back a large amount of its own stock, as well as the repurchase of the larger stake in Sands China. They returned over $1 billion to shareholders, increased ownership of the Macau assets like we're talking about. And then we have this information about buying back another $103 million. I think those are all the pieces that you're looking at and why you're making a bullish case for this stock.
Yeah, Rob, I think that's a really good description. Sands Management has returned, I want to say something like $1.2 billion to shareholders this year. That's a remarkable number. And, here's what they have going on right now. At the moment, they are in construction of a new 4th tower and concert venue in Singapore. They're both building and renovating in Macau, increasing their assets and improving their assets there. They're actively pursuing a new development in the New York City area that would be extremely expensive. This is a company, and when they restarted the dividend, these guys have plenty to do with their cash. And the fact that they devote another $100 million plus to buying more of the Macau assets that they already own, and again, where they see the daily information on, visitation and gambling and what's being spent at the tables, I think that's an indication that they believe the market is misunderstanding and undervaluing the recovery.
Great stuff, Gary, on Las Vegas Sands. As we mentioned, LVS, DKI portfolio stock, and one that Gary keeps a keen eye on. and any new developments, we'll be sure to pass those through to all of our listeners and subscribers. The fifth thing, Gary, for this week, thing number 5, we're talking about compounding long-term investing. Part of what we've adjusted on this show is doing a little bit more from an investor knowledge, education standpoint. So for this particular thing number 5 of the pivot week issue, Gary, in it for the long term, compounding is your friend. Gary, tell us why compounding is something that all investors need to know about.
So Rob, I think the point you're making is a really important one. One of the changes we've made recently on the 5 things is for thing 5, we want to provide people with some investor education. We want beginning and novice investors to start to understand basic and important concepts in investing. It's one of the ways that we hope to improve financial literacy and help people get better financial outcomes, a better material quality of your life throughout your whole life. And for this material, we're leaning heavily on my old friend and partner, Raji Kabaz from Learn Wall Street. Learn Wall Street's dedicated to helping novice investors and young people in particular learn about investing, to learn about the stock markets. And when Raji writes about compounding, he gives this great image, which, we'll put up on the screen. Imagine a snowball rolling down a mountain, and as it gets larger and larger, it picks up more and more snow, and eventually, you end up with, something that going from a small snowball to a gigantic boulder, or, potentially an avalanche. And the point is that even if you start small, over enough time, you can pick up size. And so the reason compounding matters is because over time you earn a return on your return. And so, I think it was Andrew who wrote this section, and the example he gave I thought was a good one. Imagine that you invest $1,000, and let's just say every year you're going to earn, 5%. So at the end of your first year, you'd have $1,050. And so after that first year, you'd earn a return not on the original $1,000, but on $1,050. And so your return on that second year would be more than $50. And that, it sounds like a very small change. Okay, well, 5% of, $50 is $2.50. Does it matter? Yeah, it matters, because the following year you're earning a return on $1,102, and that grows over time. And over time, as you add more capital and reinvest dividends, your growth becomes exponential. And basically what it means is, when you're thinking about investing, right? There's that old expression, right? The best time to do it was yesterday. The second best time to do it is today. What you want to do is give yourself the longest possible time frame to be investing. And the reason is because you can take advantage of compounding in doing so. It's by taking advantage of a longer time frame that you give yourself the opportunity to earn higher and higher returns, And in fact, I was on a podcast a week ago and talking about an investment that my dad had made for me, when I was a little kid. And it was, under $250. And I did nothing with it. I just let it sit there. And unfortunately, I had to pay taxes on it over decades. But decades later, even though I had to pay taxes on it, that investment was worth more than $15,000, because my dad had put $250 away, when I was a baby. And these are the kinds of things that can happen where, you can take, if you're thinking to yourself, well, wait, what? I don't have enough money to invest. Why would I just put away a couple $100? It's not enough to matter. And the answer is, well, it won't be enough to matter next year, and it won't be enough to matter in 2 or 3 years. But if you invested over decades, it could be enough to matter down the road. And that's why you start early and stick with it. It's compounding. It's being able to earn a return on your return that will help you over time. And so, I think Raji's advice here is great advice. It's advice that my dad understood and took. It's advice that, I use because I've been investing since, I was pretty young, and stick with it. This is what I do all day, every day. And so, I'd encourage you guys to start to think about it. And, if things are a little bit tight, don't be embarrassed. If you can put together, I don't know, $50. So invest $50, and you don't have to feel badly about that or be embarrassed about it. Over time that can grow.
Yeah, there was a quote in the five things, Gary, that I'm going to read from Albert Einstein. He famously said, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." I think that's a great way to kind of close out this segment, and wise words from obviously Mr. Einstein. With that being said, that concludes this week's version of the five things, the pivot week issue. As we mentioned, we'll be sure to stay in tune with everything happening over the course of this week and leading up to next week's version of the five things. Gary, any closing thoughts from you?
Well, one key thing to add on this last point, which is, a lot of people like to dollar cost average into index funds like the S&P 500 or the NASDAQ. The tickers on that are SPY and QQQ. And if you want to do that, that's totally fine. There's nothing wrong with that, with investing a little bit at a time, dollar cost averaging, which just means every week or every month you put the same amount of money in. And it's okay to try to build wealth slowly. At Deep Knowledge Investing, we take a different approach. We're taking very concentrated positions in growing companies with the potential to appreciate substantially. In just 4.5 years, we've had a large number of positions up more than 100%. And the last two stock picks we put in the portfolio, we think the opportunity is there for them to be up 5 times to 10 times over the next 5 years. And that's fine too. If that works, those returns are going to be enormous. If you, put $1,000 in something and you can turn it into $10,000 over a few years, that'll do well for you. But whether you want to own the index or individual stocks, just remember it's okay to ask for help. Reach out to us, we'll help you. Or if you have a friend who's a financial advisor, talk to them. There are lots of great places to go for help. Don't hesitate. Don't feel badly about it. Don't be embarrassed. Whatever you're doing in this, it's better to start, and it's okay to start small, and it's okay to ask for help. Final point on all of this, Rob, is, I just want to emphasize something we've talked about a lot on the show. So the Fed is going to cut rates this week. And Congress is not going to cut spending. And regardless of who wins the election in November for both the White House and for Congress, nobody's going to cut spending. And what that means is we're going to be looking at long-term inflation. And the way to think about inflation is a reduction in the purchasing power of the dollars that you own. So just be prepared. Understand that is what's coming. And, at Deep Knowledge Investing, one of the things we've done really well is help prepare people for that and actually make money from it. So, if you need help with that, again, feel free to reach out. There is nothing you or I or any of us can do to stop future inflation. It is coming, but that doesn't mean that there aren't things that we can do to protect our homes and our retirement money or your portfolio or your financial health. It doesn't have to be all bad for you individually, even if it might not be good for the country.